There we go. Yes, good morning, everyone, and welcome to our 6-monthly webinar for the Pengana Emerging Companies Fund. My name is Damien Crowley. I head up sales and marketing at Pengana. Today, Steve Black, one of the co-portfolio managers of the fund, will be providing an update on the fund. Given the recent market gyrations, we believe this is fairly timely for you and your clients. Steve is going to speak for around 20 minutes, and then he'll go through the presentation deck in that time. And then after that, he'll be available to answer any questions that you may have. Some people have submitted questions beforehand, which I have in front of me. But if during Steve's presentation you have a question, please just go online and obviously type that in, and then we'll attempt to answer all questions at the end. Steve, I'll pass over to you. Thanks, Steve.
Thanks, Damien, and thanks to those that have dialed in. So as we've done in the past, we every 6 months we look to update the market in terms of not just the portfolio, but what we're learning from those managers of small companies that we talk to. So it's always timely around this time of year, having just conducted the best part of 60 or 70 meetings one-on-one at the time of the roadshows of companies' results just concluded. So just on slide 2 there to kick off. So the highlights for the last 6 months, the performance of the fund was up 12.5%, comparing to the small ordinaries up 8.9%, industrials 10.4%, and the small resources stocks, which have been doing very well in the last couple of years, were contributed a little less in the last 6 months. Probably one of the topics worth clarifying and going into a bit more detail is the distribution policy with the fund. You'd be aware that we paid a larger distribution at 30 June of 15%, which was made up of 5% capital return. And I've got a slide on that coming up, but suffice to say that we're very close to our hearts is the need to keep this fund size at a manageable level, and we'll continue to look at the size of our distribution every 6 months, and that's obviously a strong alignment of interest there for the benefit of all. In terms of the overachievers, underachievers, in a mixed 6-month period with small cap investing, you've always got some stellar results, and you've got some companies that tend to always surprise and disappoint. So Praemium up 90%, Pinnacle Investments up 86%, Alliance Aviation up 46%, Charter Hall Group up 25%, and then the lowlights, Pro-Pac Packaging down 42%. Disappointing, albeit a very small weight at only 0.5% of the fund. Australian Finance Group 15% down. Civic Smiles we've exited and it's down 15%. I'll come to that later as well. And National Pet Care also down 12%. And we've actually sold those three, the first three I mentioned there out of the portfolio. And the portfolio, one of the KPIs you'd be aware of with us, generating all our own ideas with the number of companies we see. We turn over a lot of stones, and there was 119 one-on-one meetings the last 6 months. Portfolio turnover about 40% is consistent with what the fund has tended to turn over in the past, and the fund has grown to the end of September to just shy of $900 million, which was relatively flat in the 6-month period. So you can see there that the performance of the 6 months was largely what we distributed, leaving their fund size relatively flat. So the next page, slide 3, just a reminder of who we are. So we're jointly owned, obviously, by Pengana Capital, our parent company that is now listed, and then Ed and I own the other 25% of the business. We've been running this fund now for 14 years. And the track record over that period has been quite strong, and certainly one of the highlights we think for the fund, and one of the reasons the fund should be attractive to your investors, is that stability of management. So the analyst talent of Ed and I is the same team and same skill set that's been there for the whole journey of 14 years. We're 100% focused on this product and this product only. There's no separated mandates on the side or other contribution that we put into place for other funds at Pengana. And then that alignment of interest, no doubt, is evident with regards to the capital return, keeping the fund at a respectable level so we can continue to be nimble and outperform. So slide 4 there is just a summary of the performance over the journey, and I guess it shows the power of compounding over that time, with 14.5% per annum return after fees against the market generating 5 to 6% per annum. is obviously a pleasing outcome in all market conditions. And for us, it's more than just performance. We spend a lot of time assessing risk of stocks at the stock level, but also at the portfolio construction side of things. And I think you would agree that the ability for a fund manager to repeat the past is often dictated by the type of risk they have taken to generate those returns. So just on that, the next page is just a look at why we exclude resource stocks from our investable universe. We don't invest in mining companies. The chart on the right there on page 5 just measures the percentage of the small resources index that is comprised of loss-making companies. So half of the small resources index is mining companies that don't make money. They're obviously in their exploration phase, or that they're digging a resource out of the ground that's not profitable. So, and then on the left side of that page is a chart just mapping out the percentage of the small ordinaries index that is represented by mining companies. So think of it this way, that somewhere between 20 and 40% of the small ordinaries is generally resource stocks, of which half are loss-making. So multiply the two, and you tend to have 10 to 20% of the small ordinaries index that are in loss-making companies. So if you're investing in the broader index, or a fund manager that invests in the broader index, then you're going to have a good chunk of your portfolio in loss-making companies. And it's probably not a lot, it's not something that a lot of investors recognise or realise. There comes a lot more inherent risk, obviously, investing in loss-making companies. They're harder to value, and we would argue strongly they're a lot more speculative. So next page, we think about risk at stock level. So it's not just removing the resource stocks, but you're probably across the fact that we don't invest in highly cyclical companies unless they're exceptionally cheap. We prefer to manage money that's invested in high-quality franchise businesses with proven management teams that we back. But then also at the company, the structural level in terms of the fund, we want to make sure that we're staying nimble enough to be able to move in and out of stocks as required. And that's the discussion around actively managing capacity. So this bar graph here, since we started the fund, shows when we've opened and closed. The last 4 or 5 years since soft closure, we've been also topping up distributions with capital returns, in the last year obviously being a larger than average capital return. And that's something we'll continue to monitor from period to period. The next slide looks at, this is from Lonsec. So what it's measuring here is the volatility of the fund vis-a-vis its benchmark, and it's a standard deviation measure of the volatility of the stocks in the portfolio versus the variation or volatility of the stocks in the benchmark. So you can see that whilst delivering great returns and outperforming, we're also taking less risk on average than our benchmark. And I guess that's particularly interesting given that we own a lot of small caps that aren't even in the, or smaller micro cap stocks that aren't even in that benchmark, which all else being equal would be more volatile. And bringing all that together on slide 8, this is an interesting chart. Again from Lonsec, just looking as to when this fund outperforms. So it tends to outperform in down markets more than up markets. So 75 to 80% of the time, this fund will outperform when the markets are falling. And obviously when markets are rising, when we don't own so much the highly speculative stocks that are running hard when risk is on, nor the mining companies, and so we don't tend to perform quite as well when markets are running very hard. So it is you can take, I guess, confidence from that. It is a very defensively placed portfolio. So moving from the here and now in terms of the portfolio and what has been achieved to some current observations in the market and positioning of the fund. So I've listed there on the next page the recent purchases in the last 6 months and some sales there. Very quickly, Clover Corporation, with the refiner of omega-3 oils out of tuna, they have this encapsulated technology which in effect coats this omega-3 oils, and most of which ends up in baby formula. And as we all know, that demand out of China is very strong, so they're benefiting from that. Emeco is a heavy equipment rental business, is highly leveraged to the current upturn in the capex cycle, again in the mining industry. Integral Diagnostics is a diagnostic imaging business. As preventative care continues to grow, around 5 to 7% per annum, radiology businesses are performing very well. then the recent sales, RCL Tomlinson was the stock we sold in recent times, but before the downgrade and capital raising, and I've got a chart on that, so I'll park that. Tourism Holdings was a very good outcome for us. We'd held that for about 7 years and was a 5-bagger in that time. GUD Holdings we disposed of, and in fact we'd sold down our Bapcor position as well. This time last year we would have spoken about Bapcor being a top 5 holding, principally off the back of the take-up of the electric car. So with the CO2 emissions coming from the combustion engine and the news coming particularly out of Europe, where in the next 15 years or so, the expectations are there won't, all cars will be electric that are sold into the marketplace in some of those European countries. That's a structural change we think will really hit hard some of these providers of oil filters and GUDs. From GUD's perspective, or Bapcor as a wholesale and provider of parts to the auto electricians and mechanics. So there's about half as many parts in an electric car that move through the combustion engine, so there'll just be less need for the services of these companies. So that structural change we've had to allow for in our modelling and triggered those sales. Australian Finance Group is they're a mortgage broker, the largest in Australia. The Banking Royal Commission for us says that all commissions are in focus, so we'd prefer to sell that stock, come back to it once the dust settles. Pacific Smiles, let me come back to that one. I've got a chart on that. That's been a long-term holder for us that's been disappointing. And then Challenger Group, we recently sold as well. Just turning more to the market and what we've learned from the companies we've spoken to. So the reporting season just concluded, I think generally was quite good and above expectations, led to some strong share price reactions. But probably the more warning cautionary remark I would make would be that since then, or in the particular tailing into the end of the financial year and also into this the balance of this calendar year, is we're starting to see finally the wealth effect of declining property values and the tightening of lending practices from banks. That's putting the pinch on consumer spending. So stocks like Domain Group, which you would have seen a profit warning recently with listings in the real estate market in Sydney down 7%. Michael Hill, a fine jeweller, saw negative 15% comp store growth in Australia. New car sales down 5%. Harley Davidson's down 25%. Reject Shop yesterday. There's a lot of signs of the consumer is really fatiguing in terms of their ability to afford from the discretionary perspective purchases. So against that backdrop, we don't own, we own very limited retail in our portfolio and no building material stocks in our portfolio. We think it'll be quite tough for those businesses going forward. Linked to that is some of these accounting changes that are coming through. A lot of people aren't aware that the start of next year there's AASB 16, which is the accounting standard on leases. As boring as it sounds, it can have quite a dramatic effect on some of these retailers' profit and loss statements. Moves what is off balance sheet operating leases onto the balance sheet, treats them like finance leases, and then there's that increases the indebtedness of the company, and so that's something to watch for as it relates to potential covenant breaches. And then and also there's a change to the P&L that we spoke to every company through the reporting season that was affected by this, and everyone's still very vague as to how it's going to affect them. It's interesting yesterday that Reject Shop came out. It's one of the few companies I've seen come out with a comment on it when they came out with their AGM comments day before yesterday, and they were saying it's going to affect their profits by 10 to 15% negatively next year because of that accounting change. It doesn't change cash flow, but it nevertheless, the optics don't look great in terms of an earnings downgrade. So something to watch. And then we talked to the fact that the reporting season just gone is obviously critical and important, and you take a deep breath, but it's the next 6 weeks that are also exceptionally noteworthy because that's the AGM season. So there'll be a lot of stocks coming out, I think, just referencing the slowdown in consumer spending and potentially blaming that for some sobering outlook comments, plus the lease accounting standard changes. There might be some more detail on that as well. So just over the page, rising bond yields in the US, this is more to the market, is clearly finally taken, the equity markets have finally taken notice of, and that chart there on price earnings ratios on page 10 just illustrates how the market is redlining on valuation. So we all need to be very careful, of course, in what we pay, and the high PE stocks, long duration, bond type behaved stocks are the ones that will be, no doubt, continue to be affected by the jitteriness of the market and bond yields rising in the US. The next slide, I've got a few slides here now addressing, I guess, one of our themes running through our portfolio, and that's the investment platform providers, so the investment management software that financial planners use. We own shares in Netwealth, Hub24, Praemium. They've all performed very well for us. Even before the Banking Royal Commission, they had some very strong tailwinds driving a lot of churn from the old legacy bank affiliated platforms across to their new specialty platforms. And I think that if you look at the Banking Royal Commission, there's only really two key takeouts for us from that commission, or the interim rulings, and that is that the FOFA rules that were put in place a good 4 to 5 years ago just weren't really being adhered to. They were largely being ignored and certainly weren't being policed by the regulators. So that's about to change, and the best interest test, I think, will be a far greater focus. Consumers or clients are far more aware of it and will ask about it, and obviously planners will need to adhere to it a lot more closely now. And then also the removal of the grandfathered commissions. That's another reason why a lot of this platform money that was arguably quite sticky will no longer be sticky, and I think a lot of that will migrate across to these newer, better specialty platforms with this far greater functionality. And to be frank, in the best interest tests, advisors would at least have to consider these new platforms, given that they do provide a better service and a better sort of tactical and other sort of benefits for potential investors. So the big four banks and AMP, they still talk for about 70% of the market, and there's that real independence of product, advice and platform that I think is the way forward. The vertical integrated models days, I think, are largely numbered across financial services sector. Over the page there, just the backdrop to the industry. So it's slide 12. So you can see there how dominant those legacy products are. So $850 billion market. The big banks and AMP, only BT Panorama are really putting up a real good show at trying to keep their share of the marketplace, albeit their technology is still behind Netwealth and Hub24 in particular, and the service levels, as measured by investment trends data, is certainly substandard. So even if they do catch up on those two measures, they've still got that structural problem of not being independent like Netwealth and Hub24 are. And then the effects of that are seen in spades there on that chart on the right-hand side of page 12. We can see the exodus of advisors from the banks, the affiliated bank networks. And this technology from these new platforms, of course, is helping these planners leave, because it's an enabler for them to set up under their own license and migrate flow across to the new platforms. Slide 13 there is that it makes it very obvious that that churn from the legacy products across to the newer products. And again, that turning point when FOFA laws came in, and this trend was happening before the Banking Royal Commission, and we would argue strongly it'll speed up from here. I'll move to slide 15. This is a summary as it relates to valuations and our view on investment thesis on Netwealth. So that all sounds great. We've got to bring it back to what the market's implying in a valuation sense of Netwealth, because it is trading on a forward-looking PE of 50 times, which is, in anyone's language, is quite a large PE. Well, put very simply in our modelling, they currently have about $20 billion on their platform, growing at least $5 billion per annum. This chart shows you that they've got under 2.5% of the market, but they're taking close to 35–40% of net flows to market, as is reported each quarter. So it's our belief in the next 6 years they will grow from 20 billion to 80 billion. They'll still have around 7%, 8% of the market at that stage. So still not dominant, still smaller than the current top 4 or 5. And that plays out even with a bit of price decay, which we would expect in terms of how they charge their product, then the current P of 50 moves down to a P of about 12 times. And that's, in essence, why we still are favourable towards this stock, notwithstanding the fact that the share price has doubled since IPO. Now, very quickly, the decoupling of that advice platform and product event is meaning that also manufacturers like Pengana or PINNACLE will, I think, continue to grow because they've got that independence from the banks. And Pinnacle is a very good investment for us, and we will expect it to continue to be so with this rare outcome of having some very high achieving funds in terms of performance, management talent, with very high ratings, with a very motivated sales network that's doubled in the last 2 years, and plenty of capacity. And they're usually the 4 ingredients for a fund manager to do exceptionally well. Slide 18 is just a few stock stories very quickly. Lifestyle Communities, we've spoken ad nauseum about that in the past. It's still one of our preferred stocks in the fund. I can talk about that if you prefer later. Pacific Smiles, slide 19. That's a stock that hasn't worked for us, to be frank. In the interest of full disclosure, this is a stock that has disappointed, and there's been a few changes in the market, principally on the back of the reforms that the Labor Party are looking to bring in if they win the election for the private health insurance industry. Capping private health insurance premiums at 2% growth per annum for 2 years is going to mean that the private health insurers are going to be really struggling to grow profits. They'll fall. We sold out of NIB for that reason, but it also means that down the chain, that who they pay their money to, be it the private hospitals or the ancillary providers like Pacific Smiles, where 80% of their money comes from private health insurance cover, they'll get squeezed as well. And so we would expect that's going to be fairly disappointing for Pacific Smiles in the next 2 or 3 years as that transitions. And also the CEO, who we very highly regarded, recently departed, which is never a great sign. And then over the page, so RCR Tomlinson, we sold out of that, thankfully, at the interim result, because there was a disconnect for us between cash flow and profit. Never a great sign. The building blocks between the operating cash flow and operating profit as to the reasons weren't convincing to us. It was due to a contract dispute, and they've since come up short on that and had to fully disclose that they weren't getting the money they hoped for. And also they've mispriced some solar contracts and had to do a very large dilutionary capital raising in recent times, but as I said, we sold out of that back in about March. And then in the last slide there is just the top 10 holdings in the fund. So that said, I'm happy to answer any questions.
Thanks, Steve. I've got a couple of questions that have come through. First question is from Dane. How does the team view the higher valuation multiples forming in the small cap market, especially in the market dialing disrupted tech stocks, several of which are in the portfolio? Is there a risk the multiples are borrowing too much from the future?
Absolutely there is, yeah. No, and that's something we need to be mindful of with all our investments. So we are underweight tech as it relates to fintech. We're certainly overweight because of the strong view that we have in that investment platform space. But apart from that, we haven't got a lot of tech in the portfolio. And if you think about it this way, the tech that really is redlining are the FANG stocks that we know about in the US, and there's an equivalent acronym in Australia called the WAX stocks. And those 5 stocks we're certainly underweight. So Altium is one of those, and that's the only one we have with an overweight position. That's a very small overweight position. So we need to, as I said, be very mindful of high valuations, because the market, I think, is going to be a lot more sceptical about paying too ritzy a PE, given particularly what bond markets are doing at the moment. And that's why we've had to have a very strong conviction in our fintech exposure as to why we own those, given the PEs they're on.
Thanks, Steve. Steve, a question from Peter. Can you just explain why the fund is defensive in a falling market?
Defensive in a falling market. So I assume that's referring to the when we outperform, which is slide 8. So when the markets fall, down periods, we tend to outperform. So we are relatively defensive. That's really just an outcome of our philosophy of investing and our process over a 14-year period. That's it's more, as I say, an outcome of our the risks we take, and we don't own those mining companies. We don't own the highly running tech stocks, and we do our due diligence in making sure that the companies we own have recurring revenue streams where we can. And then when markets fall, because they've got strong intrinsic valuation support, they tend to outperform. So that's just an outcome of how we see the world and how we invest.
Thanks, Steve. Steve, there's a couple of questions on Pinnacle. Maybe I'll just give both of them to you. Pinnacle is trading on a high PE as well. How do you value Pinnacle? And any initial views on Pinnacle's announced new affiliate this morning?
So slide 17, I didn't spend any time on this, but so you can see all the strategies of Pinnacle at the bottom there, and this is obviously to financial year 18 is actual fund size, and then the growth beyond that as expected by Ord Minnett, which we broadly agree with in our modelling. This is a fund that's grown from 10 billion to 48 billion in 5 years, and the capacity, which is a key, the KPI you need to consider with any fund, is around 200 billion. So that's not to say that they're going to get there, obviously, because not every fund will work, but purely put off the capabilities they have and the capacity that each of those capabilities have. If they continue to outperform and the recommended all the ratings have remained strong, we would expect that they'll continue to grow very, very quickly. And so the current PE, I think it's about 25 times, but it falls pretty quickly with that fund growth. So no, we can certainly justify that. And then today's announcement, I mean, I think what you're referring to, I just saw the headline before it came in today, but they've had a tie-up with Blue Sky for their the LIC of Blue Sky, which is BAF, and that's only a $180 million product. We'll have to spend some time reading the detail, but one of the real benefits of Pinnacle is they because it's got such a high performing culture, fund managers want to join them, because what fund manager wouldn't want to leave a big conflicted bank, start again on their own, retain somewhere between 50-60% of the business, Pinnacle own the other 30-40%, and Pinnacle can point to the successes of their marketers in raising the money for them in quick time. And there's no better evidence of that than Jacob Mitchell from Antipodes, where he raised money after leaving Platinum in no time at all. And they can just point at the scoreboard, and that's pretty enticing for a lot of fund managers. So it's more than just the products they have now. We would expect they're going to add 2 or 3 teams every year.
Thanks, Steve. Steve, comments re Babcorp and electric vehicles seem way too early for the Australian market. Your comments, please, from Steve.
No, it certainly are. Yeah. No, it certainly is, and that's exactly right. But then many forecasters, investors would have said the same about print media when Fairfax was running, or when Fairfax even listed, probably 16 years ago. But eventually catches up on you, and that is a real risk that we've just gone way too early. But there's no doubt in our mind there is that structural problem, and we just need to allow for an evaluation and prefer to be early on that. It doesn't mean we'd ignore them, and Babcorp we still own, and we're overweight, but the risks are now greater, and so we've just pared back our weighting because of that.
Thanks, Steve. There's 2 questions that asked for your view on Vocus, and also one question asking your view on Isentia.
Isentia, was that the one?
Isentia, yeah.
So Vocus, that's an interesting one. We've got a meeting with new management there in the next week. So we'll we'll wait until we've had those meetings to form a view. But Vocus, we had a very strong, it's been a very strong performer over the years for us, and thankfully we got out at the right time before it caved in, the share price. And they got a bit found out with all the acquisitions. They weren't integrated properly, but with new management and time having passed, we'll have another fresh look at that. But they are operating in a very fast-moving place, being telecommunications, with a desperate incumbent in Telstra. So we just got to be mindful of the fact that there will be a lot of unintended consequences of a wounded incumbent competitor, and allow for that. But no, we've got a watching brief on that one. As I said, we'll meet management next week. Essentia is a stock we used to own a long time ago. That's had a lot of problems with regards to management and competitive tension in their core business. And remembering that as in effect a search engine for newspaper clippings, it's a bit of a decaying industry and relevance given the internet and what you can search for on the internet these days. So, and to be frank, its market cap's so small now that it's probably not even investment grade given the lack of turnover in the stock.
Thanks, Steve. A few more questions coming through. Firstly, have you considered investing in Costa Group in light of the recent pullback in valuation? Thematic makes a lot of sense.
Yeah, we've never invested in Costa to our frustration when it was running, but and we did meet them again recently after the profit downgrade at their interim result. For us, it's still far too risky. They did a very good job. Did a very good job convincing the market that they didn't have the normal associated agricultural risk in the portfolio of products that they grow and sell. But I think what the last result has shown us that they do have some protection because they grow mushrooms, they're undercover, and they're not as susceptible to disease and weather. But at the end of the day, they've still got a lot of products where they've got commodity price risk and growing risk, and that is probably the lesson that the market's learnt in the re-rating of the stock PE sense from the interim result, and we think it's still on a very high risk PE, given that the risks in as it relates to those agricultural factors.
Thanks, Steve. Steve, a question from Sky. Do you have a view on Reliance and the John Guest acquisition?
Yeah, we own Reliance. We like Reliance. That sort of push to connect technology that they have in the US market is dominant, and there's some good growth prospects in the US, continual growth prospects. And then the John McGrath seems like a very sensible strategic acquisition. It's equivalent type business in the European market, except it's selling more to the new house or developer market, whereas in the US, the SharkBite product, which is Bush Connect product they sell in the US, is more to the repairs market. So there seems to be very good overlap there in terms of the ways to market, and I think both those geographies will learn from each other in terms of how they sell their products. So, and something you always look for with a vendor is the reason for selling, and there's certainly a very genuine reasons for the family to sell us. So no, we thought it was a very, very shrewd and sensible acquisition.
Thanks, Steve. Question from William. Do you believe BT Panorama is a credible threat to smaller platforms like Netwealth?
It's a very good question. We've spent a lot of time looking at that today. And many of you would be aware that they've done some blanket advertising of their product vis-a-vis Netwealth and Hub24, and particularly as it relates to pricing. We find that a little misleading, and the two reasons for that are that they're comparing their pricing to Netwealth and Hub24 at their rack rate or the list price, but advisors don't ever pay that. It's a negotiated outcome. So it's when negotiated, the feedback we get is a very similar level of fee, plus Panorama only pay half the cash margin the Netwealth and Hub24 pay, which many would be aware of. So pricing, I don't think they've got too big an advantage, if any, But their biggest issue is really technology independence, lack thereof, and service levels, which are quite poor, and they're going to be hard to overcome. So no, I don't think of them as a strong competitor. I think of them as probably the best of the incumbents, and that may allow them to retain a lot of the existing money they have on their own legacy platform as they move it across to Panorama. They've got, broadly speaking, about 17% of the market. So even if they're successful there, there's still 83% of the market up for grabs for these new specialty players. And they have less than 6% now in combination, all those specialty players.
Thanks, Steve. Next question from Phil. Apart from health insurance and hospitals, what is your view on peripheral health stocks such as Blackmores, BWX, A2 and so on?
Case by case, so those stocks that are more driven by China, which is the ones you've just mentioned there, the demand out of China, we find that a little fluky and uncertain with the best of times, the unpredictable regulatory framework from which they have to operate. So we find them very hard to model, and any stock that we can't model with relative confidence, given our conservative approach, we tend not to own them. So we've not owned those stocks for a long time. Bellamy's we used to own when it first floated, but it's just got too ritzy on a price level, so we sold that. In terms of more broadly the healthcare space, as I said earlier, we own Integral Diagnostics, we own Capital Health as well, so both of those are tapped into that preventative sort of healthcare thematic, which is the government continues to sponsor, and it obviously makes total sense. They're particularly that radiology space is a very fragmented market, and both those companies are corporatising that market and sensibly buying up small players at very cheap multiples. So we're very excited by those two companies in the market. And I don't. In a healthcare sense, a lot of the healthcare stocks tend to be large caps these days, so there's not a lot of other exposure in the small cap space. Private health insurance, yes, but when we've recently sold out of that for the reasons I highlighted earlier.
Thanks, Steve. Question from Peter. What do you see the growth prospects of Praemium in the next 3 to 5 years?
They're tapped into the same dynamic that I spoke to on the platform providers, albeit they're more of an SMA than a fully functional platform. They're working hard to become a fully functional platform, but their key strength and niche is SMAs, and they're exceptional at it. So they're growing very quickly as well. Because of the same trends that are playing out in the marketplace, but for us it's a little less exciting and smaller company, so we keep our weight a lot lower in our fund accordingly.
Steve, this may be the final question, but from Daryl, where do you see the ASX going from here, and how should small caps relatively perform in this environment?
Well, I don't know where the ASX is going. I guess we run a fully invested fund for that reason. We're not going to time markets. We'll allow the asset allocation decision for smarter people to make that call. But and what I can say though is that you do tend to find that when the local economy is performing better than the global economy, then small caps tend to outperform, and that's just simply a case of that. The broader, larger companies tend to have a further reach overseas and are therefore going to be buffeted by slowdowns overseas or growth overseas. Also in the small caps that have more generally focused with customers in the Australian market because they're less diverse, less sophisticated businesses. So it's a very broad brushed thought piece, but in an economic sense, the Australian economy does better. It's usually the small caps in Australia that do better. And then you need to look at the mix of the index as well. So banks are on the nose. Not many of those are in the small ordinaries, so it'll hold back the larger caps. And then there's more tech stocks in the small caps as well. So it's a mixed issue, plus the economic overlay as to which economies are doing better. I guess we're less sort of concerned about that backdrop, and more we'll just pick the eyes out of the 800 stocks that we have to look at, and building the best portfolio of 50 or 60 that we can from that 800 or so.
Steve, a couple of late entrance questions. Any chance of a listed version of the fund?
None.
So that might be a quick one. Next.
We know our investor base, and no, I think they prefer us to be unlisted.
A question from Phil: does the tourism sector still offer opportunities? Flight Centre, Webjet, Hello World, hotel stocks, etc.
For sure, yeah. No, we will look at each of those on their merits, and Webjet we used to own, we sold down as the valuation got a little bit too exy for us. We looked at Hello World recently. We've got a lot more work on that. Flight Centre is a stock that performed relatively well. It's come back a bit recently, so we'll dust off the file on that one. So no, they're stocks that in a growing industry, which travel is, that can present great opportunities, and we'll just beat management as often as we can to reassess.
Final question then, Steve. Do you have a view on Mayne Pharma?
Not a strong view. It's one that we've not owned. It's sort of this is the generic drug business, principally from the US, and it's an interesting company from the perspective that they have a product that decays. You've got a generic, you sell a lot at the start, and then over time other generics come to market for the drugs, and it's just sort of that portfolio of drugs that you have fall away. And so it's really just a game of to come forward with more and more generic drugs to replace what is decaying to stand still, let alone grow. So it's a very, very difficult business to value, and they've made some acquisitions which makes it even more inherently risky and dangerous and difficult. So we've always had a fairly, I guess, a very sort of not negative, but we've always found it very difficult to value, and so our position in the stock has never led us to buy it.
Steve, I might leave it there, and thank you everyone for your questions. There's a couple of questions that we may come back to some people on, but we'll call them individually around those questions in the interest of time. Thank you for joining us today and for sending through your questions. I hope you found it of use, the session, for yourselves and for your clients, to assist with your communications with them. We will send a copy of the presentation and a link to the recording to you probably early next week. So thanks again for joining us today, and have a good day. Thank you.